Hey, what's up, everyone? Welcome into episode 38 of Great Quarter Guys. I'm your host, Andrew Cox. I've got with me my boss and co-host, Kevin Hill. How are we, Kevin?
We're doing good today.
Yeah, this is episode number 38. I couldn't think of a prominent football player. We've been going with football players as the number, so I took Kurt Schilling as the number 38. That's going to be our, this is the Kurt Schilling episode.
Okay. The Bloody Sock?
Bloody Sock.
The Bloody Sock episode?
The Bloody Sock episode, yeah.
I think we're going to talk about bankruptcy, and I think he went through a famous one, or not a famous one, but a well-known.
Schilling did?
Yeah, like who's a computer software gaming company.
Oh, he got involved in it.
Yeah, he got involved in it.
It's crazy how many of those famous athletes get involved in some super shady businesses.
They really do. Have you ever seen the 30 for 30?
Yeah,
on,
Broke.
Yeah, one of the best
good.
30 for 30s, and entertainment, athletes. I think what was the statistic? Like 80% of them go through bankruptcy at least once.
It's incredible. I mean, I remember seeing, Mike Tyson had made $400 million in his career, and within like 6 or 8 years after him stop boxing, he was completely out of money. It's bonkers. But we'll get to our show because we're going to talk about money as well a lot today. It's interactive, so get on LinkedIn, leave me some comments if you have a company or a topic you want us to talk about. If we know anything about it, we'll try to talk about it for you guys. But we got a cool show. We got Seth Holm, which will be joining us here in a moment. He is, of course, a part of our team, an original host here of Great Quarter Guys. I have one quick update to a previous long short that we did back in December. I saw some videos back in December of Iron Mike Tyson, just looking like a monster, and we did the long short whether we'd see him in the ring in 2020. It seems that we will. They've got a fight against Roy Jones Jr. Booked for September 14th. So you got a 51-year-old and a 54-year-old fighting in an 8-round match with no headgear. I don't know how I feel about it, but I am excited. I'll tell you that much.
Think it'll go 8 rounds?
No, I don't.
Think it'll go 3 rounds?
I hope so, because I'm probably going to pay for it and buy it, so I hope it goes at least 3.
They might just get exhausted.
They're old dudes.
Knockout or fellas. TKO or anything.
Yeah, I mean, it's going to be good, though. So let's go ahead and bring on Seth Holm. Seth, how are we today, my man? You're joining us. I think you're at home with the kids, right?
No, I'm actually at my parents-in-law. I have my own office over here out of town. So, I'm doing well. Thanks for having me on again.
Yeah, well, great to have you back, my man. So we're going to continue with the same thing that we did 2 weeks ago. We are on a little bit of a break. We didn't have a show last week because of FreightWaves Live 3PL Summit, but we're going to keep going with our ode to highly questionable sí or no. This is you care or nah. The first one, I'll start with you, Seth. Target and Walmart both announced they will be closing on Thanksgiving. Do you care or nah?
So first of all, they're just closing. I haven't looked into this. They're just closing like physical stores, right? Obviously, their
Correct.
Websites and e-commerce will still be on. Yeah, so I'll go with no there. I think that most of their sales for Black Friday and Thanksgiving and all that are going online anyways. And so if people can't go into the store, I think they'll just go online.
How about you, Kevin?
I do care. I think so. A C. Right, because I do care, and I agree with Seth though that most of their sales are online. Hopefully, we see that as a trend going forward, so they don't have to be open on holidays. Thanksgiving, Christmas, and we can go back to kind of where we were 20 or 30 years ago.
Allowing those people to be with their families.
Yeah. Let people off on those holidays, and people can just do online ordering.
I am with Seth on this one. I don't really care about this. I avoid these places to my best ability on Black Friday and Thanksgiving because of the rush. And also last year, I don't know if you guys remember, they started to offer those Black Friday deals like at the beginning of November online for anybody that was looking, just to kind of relieve the pressure on them, on their supply chains on Black Friday. So no, I don't care. I'll be getting my stuff November 1st anyway. All right, so number 2, we've got the Chinese fintech giant that is currently under Alibaba, but it is called Ant Financial. They have begun discussions for a dual-listed public offering in Hong Kong and Shanghai. Seth, do you care or no?
Yeah, definitely care. Ant Financial, this will be, shortly will probably be one of the biggest companies in the world. I have not looked into it in detail, but, I can tell you, 1.4 billion Chinese people that love their digital payments. So I think this will definitely be one that everyone should watch.
Kev?
They aren't listing in the States, though.
No,
right?
So they'll have Hong Kong and Shanghai.
Yeah, in Shanghai. I'm going to go with no. I think there'll probably be a very large financial company and one of the biggest stocks in the world, but I kind of try to stick to domestic stocks and domestic opportunities, so whatever happens is fine with me.
Nice. I do care, not only because it's a huge company and I am very long Alibaba, but also because I think it's a really important thing that they've avoided a listing in the U.S. They've chosen to go with Hong Kong and Shanghai rather than go on Wall Street. It was just 2014 when Alibaba did their listing on the Nasdaq, and they raised, I don't remember, $25 billion or something, some huge IPO. So I think it's a huge deal that they're not choosing to do it in the U.S., that they're choosing it to do in Hong Kong and in Shanghai. So that's one thing that's why I care about that one. Number 3 is, all right, I'll start with you on this one, Kevin, because you're the Tesla bear of us. Tesla was profitable in Q2, but one of the main reasons is because they were able to market almost $500 million in regulatory credit sales. Does this matter to you? You care or not?
I do care. I think it's I think it's a non-core business. Even though those credits do exist and the regulatory credits, I think I don't think it's I don't think it's a core business of Tesla. So whenever you're making most of your profits from or that revenue from a non-core business, I think I think it could go away at any time.
Yeah, and I'll get to what the CFO said about that. But Seth, what do you care? Do you care or no about Tesla's regulatory credits in Q2?
No. You know how I feel, Andrew. The bears on Tesla just move the goalposts. No matter what, it started out with, well, they'll never be able to make a car. Now they make a car better than everyone else, and now it's about the regulatory tax credits, and they're hoping that the dam breaks out in where is that, Shanghai dam? So it takes out Giga Shanghai. No, I do not care about this. I don't think it's a big deal.
Yeah, Seth and I are on the same boat here. I don't care, but I do want to mention one thing that the CFO of Tesla said. He says that he doesn't. They don't have the assumption that the regulatory credits will contribute significantly to their future, but in the exact same breath, he also said that he expects the credit revenue to double this year over last year. So it is an important part of their business right now. It is the one piece of business that got them to profitability this quarter, this is a really important quarter because it's 4 in a row, access to the S&P 500. So these regulatory credits are going to go away in the near future, but for right now, they're helping Tesla, and that helps me. So I like it.
So I have a couple things.
Go for it.
So basically, if you come out with a Tesla question next week, I'm going to move the goalpost again. Don't worry about that, Seth. I will keep moving it. I will keep moving it. But we do have something on Walmart, right? And we'll get to Walmart here in a second. Juan Ortega, LATAM regional manager, and I can't see anything else, but how the supply chain for Walmart and all of the big box structures changing due to COVID-19, and I think we have a segment.
We have a whole segment on whether or not we think Walmart can double. So we'll get to Juan's question here in a moment.
I said it before I realized. Oh yeah, we have a whole segment coming up.
We will
stay tuned.
Do our best to answer that. So here I got some more SPAC news. We're hearing every week there's more of these blank check company merger companies. This one is actually really unique. I think it is Redbird Capital Partners. They have teamed up with Billy Beane, the executive of the Oakland A's, who's kind of the credited inventor of Moneyball and the data analytics in baseball. So they've teamed up with him, and they've created a SPAC, a $500 million SPAC to focus on businesses in sports media, and data analytics. It's gonna be called Red Ball Capital. You care or not?
I do. Is that public now?
Not yet. I think they've just announced it. I'm not sure exactly when when you can start buying it.
I'm going to write that down.
But yeah,
Red Ball Capital, because yes, I do. I'm a big fan of whatever Billy Beane does.
Yeah.
I mean, someone who can revolutionize the game and kind of dig back to the obscure data and analytics that were out there at the time. And I think he has a really good, firm grip on what the next big trend is for sports.
Nice. How about you, Seth? You care or not? Red Ball Capital.
Yeah, I do care. One thing I would say is it's kind of funny. I was thinking about, I can't remember what the expression is, but you can't throw the ball without hitting a stack these days. But that being said, I think Billy Beane and whatever it's called, the math around baseball is really cool. It'll be interesting to watch and see what he buys and to see what he invests in and see if he's successful. So, yeah, I do care.
All right, yeah, so we got our first 3 for 3 caring with Red Ball. I care as well. Billy Beane is the man, so I'm excited to see what he can do as well. So we got 2 more quick ones for you. So then these are both some deals we've seen in logistics space. The first one, which was announced, I think, last week, this is between the autonomous vehicle startup Too Simple and Navistar. They've signed a deal to start producing autonomous vehicles by 2024. Seth, you care or not about this one?
Yeah, I do care. As you guys remember, my first paper that I did at FreightWaves, I guess 14, 15 months ago, was on a long paper on autonomous trucks. So I follow everything in the space. And, Navistar, I think, is one of the top, OEMs for heavy-duty trucks. And partnering up, I think it's a win for Too Simple. I haven't looked at all the details, but I think they said they're going to start producing these by 2024. Is that what you said? So, that seems like an aggressive timeline to me to be commercialized. So I need to read more about that because, my take was always this is a 10, 15, 20-year thing in the future. But, I care, and I'll be watching closely.
How about you, Kevin?
I'm going to say no because I'm not going to agree with Seth, but I'm going to agree with Seth 15 months ago. It's still 5-10 years away. It's a decade away, and it's all about the execution. Anyone can project out, this is when we're going to go commercial. I can build a great plan. You can build a great plan. Seth can build a great plan. There's a lot of people out there who can do these forecasts, but it's all about execution. So once they start executing it, then I'll care, but now I don't.
I care as well. I think that this model is going to be the first one to market. I don't know whether it'll be Too Simple and Navistar, but I think that the idea of having this technology-based startup partner with a large OEM, I think that's going to be the model that eventually gets there to market. I just think you have the best talent pool there when you pull them together. And this is a really good timing for Too Simple. Apparently, they were looking to raise about $250 million in the last couple of weeks. It's kind of an unusual merger, though. Apparently, Too Simple will be paying Navistar tens of millions of dollars each year to get access to their trucks, and they've also given them an equity stake. So we'll see how the structure ends up working out for Too Simple. But no, it's a great deal for Too Simple, and I'm happy for them. And the last one we got is another deal, and this one is not focused so much on trucks, but rather on delivery vans. And this is between Waymo and Fiat Chrysler. They've also partnered to try to get some autonomous delivery vans and autonomous vans, commercial vans, passenger vans to market. How about this one, Seth? You care or not?
Honestly, I looked over this one in the script. I have not had any time to look into this. So Waymo, I care about anything with Waymo. Google's, they're one of the leaders in autonomous. So I'll be watching that. I care really about on a related note about this company Workhorse, which I think we're going to talk about later, which is sort of similar to this one. So I'll sort of save that for later. But yeah, I'll be watching this one.
Kev, you watching? You care or not?
I do, and the reason why I do is because of Waymo and Google and just a limited amount of money that they can pour into any kind of investment or partnership they can do, and where Navistar and Too Simple might not have the cash to really 10x everything.
They don't have just the cash burner or the cash creator that they can go in the well to, like Google does.
Yeah, exactly. And they probably won't take that much risk, where Google has really proven that they'll take a lot of risk. They'll dump a lot of money. They'll burn a lot of money, just see what works and what doesn't. So because of that reason, I do care about this.
I don't care about this one because Fiat Chrysler to me is just a bunch of tired brands. And maybe they need some excitement in them, but we talked about Fiat Chrysler last week, how Jeep is really their only strong brand anymore. They just have a bunch of tired brands, so I don't love them. I do like the idea that Fiat Chrysler made Waymo their exclusive level 4 partner. I think that's interesting, so they're really trying to get to that level 4 as quickly as possible. So let's shift our focus a little bit back to our big topic today. We're going to talk about Walmart. We love talking about Walmart. Last week, or 2 weeks ago rather, we talked about whether Walmart is now a tech stock or what it has to do to become a tech stock. We're going to kind of continue that theme here, and the overall question we're going to try to answer is whether Walmart can double in size. We're not going to put a time horizon on it, but we'll just think how big can Walmart get, and what are the steps that needs to happen for them to get there. So the recent news has been overwhelmingly positive with the Shopify partnership and the Walmart Plus, which will be their subscription, renewable subscription bundle. But it wasn't always this way. We heard first word of this Walmart membership program back in February, and the market didn't take the news very well. They reacted negatively. Walmart actually closed down 3% on that day. But if you fast forward to just a couple weeks ago, when we heard some more concrete evidence that this was going to be a real thing, that Walmart Plus was coming to market, the stock closed up nearly 10% up for that week. So Seth, I think you'll probably be best able to answer this question. I just want to know, how could the perceived value of a Walmart membership program change so drastically in just 4 months?
Yeah, I'll get into that. But first things first, I don't think that Walmart, the company, has actually come out and confirmed this yet, which is one reason why, because I've been looking for the stock to be running more on this news, and I think maybe, it was supposedly supposed to launch by the end of July, and I forget what's today, the 28th or 29th. So we're getting, well on into the end of July. And so I think if the company came out and actually confirmed it with a press release with some details about exactly, what the offering was going to be and when it was going to launch and all that sort of stuff, I think we'll see a spike in the stock. Now, to your question, I think obviously a ton has changed. If you look back in February, that's pre-COVID, at least pre-COVID in the United States. I guess it was, there was already that outbreak in China, but a lot of people, including senior, health officials and government officials in the U.S. didn't think it was going to end up being a big deal, which they were obviously wrong about. Now, and so what that caused is that caused lockdowns, and you saw e-commerce. I think we talked about this in prior shows. E-commerce in 2019 was just like around 11% of overall retail sales in the U.S. And they're tracking. I saw they're like close to 30% of overall retail sales right now, because a lot of physical retail is still closed or has limited foot traffic. And then I saw this morning that Goldman Sachs says that they're forecasting overall e-commerce in the U.S. for the entire year of 2020. To grow 30% this year, which is, about double the rate that it's grown at for the past decade or so. So, huge deal there. Obviously, the other result of COVID has not only been a lot more shopping online, but it's favored the bigger guys, of which Walmart is one, right? And that was a little bit unfair because a lot of these big guys, their businesses got deemed essential, Walmart being one of them. And so, and the small guys had to close down, and so they can take a lot of market share. So, I think when you combine the fact of, a lot more shopping online with COVID, I think there's been probably some, permanent or semi-permanent changes in consumer behavior that are going to last. In other words, I think e-commerce if it wasn't already, really ingrained, it definitely is now. And we may not even have a vaccine, by the way, best case, where, people can go to their doctor and get vaccinated probably, June, July of next year. I think Google talked about their keeping their employees home till then. So not only that, but you're going to see another 4 quarters of just tremendous growth. And then, the other thing with Walmart is it's extremely defensive. It's a cheap place to shop. It's open, and they get 50% of their sales from groceries, which has been a booming category. So I think when you combine all that, and then they also, Walmart does the most sales of any retailer in the United States, like $500 billion, right? And so they just have this massive store base and massive consumer base that I think was low-hanging fruit there. Even if you can't, get up to that Amazon Prime level of membership, I think if you can convert Walmart customers into basically a subscription business, a la all the software and technology stocks that have been running, if you can do that, you get more customer lifetime value, you get a higher multiple in the stock and all that sort of thing. So
yes.
I think when you add all that together, that's then why the market is now actually excited about it.
Yeah, Seth, I'm really glad you brought up the point about Walmart trying to convert some of these online shoppers to do the subscription bundle here. I got some data here from AlphaWise. They did a survey, and they said that Walmart online shoppers are the least likely to be Amazon Prime members. While there's still 74% overlap here, that 74% of the Walmart online shoppers are likely to be Amazon Prime members, but that's by far the least of any other grocery retailer online. So the idea is there that it will likely lead to a better conversion rate of getting some of those current Walmart online shoppers to their own subscription service. So, but with all this said, we've kind of, currently it trades at about $1.32, market cap of $375 billion. You just went on about a 2.5-minute speech there on what Walmart has, but we didn't mention Flipkart one time. This is a company that some people kind of forget about Flipkart. So give us the 30 seconds on Flipkart and why this is going to be so pivotal to Walmart's growth moving forward.
Yeah, and I'm not on video today. I'm on the phone, so you guys I don't have the verbal and nonverbal cues to cut me off.
No way, mate.
So Flipkart, Flipkart is a huge deal too. So 30 seconds here. Flipkart is the number one. They're basically the Amazon of India, even though Amazon does exist in India. They are the number one e-commerce player in India. They've got about 40% market share. the story with Indian e-commerce is just tremendous growth. So it's probably in the first inning. It's equivalent to, it's got 1.4 billion people, the same amount of people as China, and you're probably 10, 15, 20 years behind in that growth story in terms of the e-commerce penetration. So as you see that, Alibaba now is a $700 billion market cap. Amazon's $1.5 trillion. I think, Flipkart could be, a $500 billion plus company, because the Indian e-commerce should grow at about 50% a year for the next decade.
And what percentage of
Walmart? And I forgot to mention Walmart has 80% of them.
There you go. That's what we were looking for. Well, beautiful. So we got to see to wrap this up a little bit. We got to see the investors give a valuation bump to the subscription service, which means Walmart's got to churn in some of those online shoppers into subscription people. Then we also got to see Flipkart continue growing. That's probably goes without saying. It will grow, and they own 80% of that. So there's a lot of good things happening for Walmart here. Kevin, do you have any final notes on the Walmart story?
Yeah, and thanks to our LinkedIn commentators or commenters, Matt Henning and Sheena Day, for throwing us some notes down on LinkedIn. I think it goes back to a couple weeks ago. Walmart's at that time it was about 0.7 to revenue. I think getting that subscription model in. I think Flipkart, which I don't know too much about, if it's a major player in India, that's a huge investment for them. And I think the Shopify partnership, I'm still very bullish on that.
Yeah,
and I think all of those, whether it's going to incrementally increase their sales, but I think their valuation metrics will change into maybe more of a technology company and move that from, even if it moves the valuation from 0.7 to 1.4 of sales, I mean, that's doubling. That's
it's huge.
A $260 stock then.
Yep. Yeah, it's massive. I think the last note I read, the bull case priced at 180 with the base case at 140. So people are expecting some good things from Walmart. So let's shift gears to another company with huge expectations, or a couple companies with huge expectations, rather. And this was the Barron's cover story. I think it was last week, the end of last week, beginning of this week. I can't remember. But it's about the electric truck wars and the hydrogen bubble stocks. It's basically that discussion there. So, as you mentioned earlier, Seth, we have Workhorse, who creates hydrogen-powered delivery vans. You have Nikola, which we talk about ad nauseum, which we all know what they do. They are going to build massive hydrogen trucks. Both of those company stocks have skyrocketed this year, and investors have really become convinced that the future of driving, whether it be big rigs or delivery vans or even personal cars, that it will be gasoline-free. Even Hyliion, who we've had on here, he was on What the Truck. He might have also been on the Midday Market Update, the CEO of Hyliion, that is. Even them, they have some investors, excited to buy that stock. They're going to go with a SPAC with one of those blank check companies. But the truth is, it seems to me that everybody kind of wants to be Tesla, that they want to ride the wave of Tesla right now. That valuation's gone through the roof, and the heavy-duty market is much smaller than the passenger car market, but it's still really big. I think the sales of the top 6 big rig manufacturers was around $160 billion last year, so a massive market. Seth, I want to punt this question to you because I found this comment both kind of funny and I just found it good. So Joe Spack, an analyst at RBC Capital Markets, he says that Tesla is not a business, but rather just a business plan. But I think the same probably could have been said about Tesla when they went public in 2010.
Nikola, yeah.
Oh, did I say Tesla? Okay, Nikola is not so much a business, but rather a business plan. And I think the same probably could have been said about Tesla 10 years ago. So, Seth, what do you think the difference is between Nikola today in 2020 having just IPO'd and Tesla back in 2010 having just IPO'd back then? What are the differences now?
Well, I mean, the first obvious difference, as I think through this, is, Nikola will be competing against Tesla, who is obviously the leading EV player in the entire world, because Tesla is going to come out with their own electric semi, and by 2021 is the plan. So that's one obvious difference. The other obvious difference is, Tesla is an electric vehicle company, and that's what they've bet their stake on. Whereas Nikola is a sort of a hybrid between they're going to have electric short-range trucks, and then they're a hydrogen fuel cell truck where they have to. So the other thing that they have to do, and Tesla had to build out their charging stations, but these hydrogen fuel, I think there are a lot of questions. Hydrogen isn't really proven as a fuel compared to diesel. And as we kind of talked about offline, Andrew, it'll be really expensive to build up this network. I mean, one of these stations costs supposedly, $20 million, and I think the Callan analyst on Nikola is estimating they have like 260 something of them by 10 years from now, or 2027, or whatever the number was. So that that's $5 billion in a fueling network that you have to build up. So they've got Anheuser-Busch on as a customer, but convincing people to buy one of these expensive trucks, and are they going to work, and then to pay $1 a mile for sort of a trucking as a service, I think it's a very unknown thing. Whereas I guess they're similar in the fact that maybe they're the future, but I think it'll be a harder road for Nikola than it was for Tesla.
Yeah, I think my biggest difference is even at that point, Tesla, they were producing very few cars. They only had the Roadster there, the very highly priced Roadster, but they did have a product. They had a product on the market. People could see it. People could understand what Tesla was doing. We're still a long way from that at Nikola. Nikola's expecting first trucks to be delivered in 2023 or 2024, so some time there. But I'm glad you mentioned the thing about hydrogen fuel cells not being proven, because they've been around for a while. I didn't know this, but some of the hydrogen fuel cell makers, which we'll get to in a second, they've been making hydrogen fuel cells for 20 or 30 years, and they really haven't caught on to the mainstream power usage. We see them used a lot in data centers to cool the data centers down, or in like forklifts in warehouses and whatnot. But as a long-range vehicle, I don't know if hydrogen really is going to stand up to the tail. What do you think, Kev?
I think it goes back to the battery too, right? I mean, Tesla's made such great improvements in the power and longevity of electric vehicles and the battery.
Mm-hmm.
I think you're seeing the same evolution in hydrogen as well. So I think as time goes on, the technology is going to get better. The usability is going to get better. You have this enormous infrastructure project that has to go on. $5 billion is basically table stakes for that, just to get it off the ground, which is a huge thing. Helion is taking another type of spin on that, where it's hydrogen, but it's repowered by natural gas,
right.
Renewable natural gas in the cab. So there's ways around that, and there's people looking around that. If the question is alternative vehicles a bubble right now? I don't know if that's the question.
Yeah, it's got the hydrogen fuel, alternative fuel, alternative trucks.
Of course, it's a bubble.
Yeah,
right. There's anything new that comes out, there's a bubble, and this is a definite bubble, because there's really no progress. There's just business plans, as you said.
Yeah, we don't have too much time here left, but I'll run through here. Just I mentioned the hydrogen fuel cell makers. So there's 3 companies in particular: Plug Power, Ballard Power Systems, who's been around for a long time, and Boom Energy. And those first 2 companies are up 4x in 12 months. So they're now trading at more than 50 times future cash flow. So I just think they're companies that are priced to disappoint. I mean, we've got a long way. This is a long trek, and as we said with the build out of the hydrogen network, as you said a second ago, hydrogens. I mean, Nikola says that they're going to market these cars at about $1 per mile, 95 cents per mile. I don't know whether that's before or after they bring down the price of hydrogen, but they're expecting to bring down, or they're projecting that they can bring down the price of hydrogen by nearly 75% to about $4 a kilo. I mean, that's just it's a lot of work. I don't know if the juice is going to be worth the squeeze. Investors are excited about it, but we got a long road ahead of us here. Okay, so we got a few seconds to kill here. I got something for you, Seth. We're going to have that GDP number on Thursday. You think it's better or worse than negative 30% in Q2?
I think it's going to be a little bit worse, but better than the 40 or 50%. By the way, I'm going to add one last thing here. Cautionary tale. 10 years ago, I followed this company called Clean Energy, which was run by Boone Pickett, and that didn't pan out. It had the same fueling station thing, and it made a lot of sense on a lot of levels, and that stock never panned out. So that has made me a little bit of a skeptic on the hydrogen as well.
What about you? GDP?
I remember that. I think it's going to be better than negative 30%.
Better. I do too, actually. I don't know why, but I think the analyst expectations are in the negative 30, mid 30s range. I think it'll be slightly better, but again, it's just going to be a brutal printout. What about this, Kevin? Do you think they shut down the MLB?
Yeah.
Yeah. Well, I sure hope not.
I hope not too, but I think I think NBA and NFL, it's going to be
maybe so.
Yeah.
Hey, we might be one day late next week. I think we're on a 7-day, 23.5-hour break, but we'll see you next Wednesday, guys. Thank you guys so much for tuning in. See you next time.